In this section, our primary objective is to understand the accounting problems associated with interest capitalization. There have been three approaches suggested to account for interest incurred in financing the construction or acquisition of property, plant, and equipment. The first method is to capitalize no interest charges during construction. The second method is to capitalize all costs of funds employed, whether identifiable or not. And the final approach is to capitalize only the actual costs incurred during construction. As previously stated, one approach to accounting for interest costs during construction is to capitalize no interest. However, there is a cost associated with the use of cash, regardless of its source. As a result, this method is not recommended by generally accepted accounting principles. The second possible method to account for interest during construction, charging an asset with all costs of funds employed, whether through debt or stock, is also not recommended by generally accepted accounting principles. The reason is that estimating the cost of equity is subjective and outside the historical cost framework. Capitalizing only actual costs incurred during construction is the approach recommended by GAAP. Why should interest during construction be capitalized? Capitalizing only actual costs during construction is consistent with the historical cost concept that acquiring an asset includes all costs incurred to bring the asset to the condition and location necessary for its intended use. Just like materials or labor would be included as part of the cost of a building, interest incurred during construction is as much a cost of acquiring an asset as these materials or labor, and therefore should be capitalized. In addition, capitalizing only actual costs during construction is consistent with the matching principle that revenues should be matched with the expenses that help to generate those revenues. During the construction period, an asset is not generating revenues, and therefore interest costs should be deferred or capitalized. Once construction is completed, the asset is ready for its intended use, and revenues can be earned. At this point, interest should be expensed and matched with those revenues. When implementing the GAAP method for interest capitalization, three elements must be considered. These items include 1. Qualifying assets, 2. The capitalization period, and 3. The amount to capitalize. To qualify for interest capitalization, assets must require a period of time to get them ready for their intended use. Interest costs are capitalized starting with the first expenditure related to the asset, and continues until the asset is substantially complete and ready for its intended use. Assets that qualify include assets under construction for a firm's own use, such as buildings, plants, and large machinery, and assets intended for sale or lease that are constructed as discrete projects, such as ships or real estate developments. Assets that do not qualify include assets that are ready for their intended use, such as a completed building. Assets that also do not qualify are assets that are not being used in the earnings activities of the firm and are not undergoing the activities necessary to get them ready for use. An example might be land held for speculation. The capitalization period is the period of time during which interest must be capitalized. It begins when three conditions are present. These three conditions are as follows. 1. Expenditures for the asset have been made. 2. Activities that are necessary to get the asset ready for its intended use are in progress. And 3. Interest cost is being incurred. The following questions will test your knowledge of the material covered up to this point on interest capitalization. Please select the best answer. So far, you have learned that you must capitalize interest incurred during construction. You have also learned what constitutes a qualifying asset and when the capitalization period begins. Remember that a qualifying asset is one that is under construction and not generating any revenues. The capitalization period begins when expenditures for the asset have been made, when activities that are necessary to get the asset ready for its intended use are in progress, and when interest cost is being incurred. The capitalization period ends when the asset is completed. You are now ready to determine the amount of interest to capitalize. The amount of interest to capitalize is limited to the lower of the actual interest incurred or the avoidable interest. The avoidable interest is the amount of interest that could have theoretically been avoided if expenditures for the asset had not been made. For example, let's examine Bucky Company. This company's actual interest for a project was $100,000, while the avoidable interest was $90,000. Because you take the lower of the two amounts, Bucky Company would capitalize only $90,000. To calculate the avoidable interest, you must first determine the weighted average accumulated expenditures. This amount represents the average amount of funds tied up in construction throughout the year. To compute the weighted average accumulated expenditures, the construction's expenditures are weighted by the amount of time that interest cost could be incurred on the expenditure. Let's return to our Bucky Company example. Bucky Company is building a new football stadium and makes 3 large payments to a contractor at different times throughout the year. Let's consider the March payment. Because there are only 10 months left in the year as of March 1st, the $240,000 is really only tied up in construction for 10/12ths of the year. The $240,000 times the 10/12ths, which equals $200,000, is the weighted average expenditure for the March payment. The weighted average expenditures for the other payments throughout the year can be calculated the same way. The sum of all the weighted payments equals the total weighted average accumulated expenditures. Now that we have calculated the weighted average accumulated expenditure, we multiply this amount by the appropriate interest rate. In the case where the company has borrowed to finance construction, we use the interest rate on that borrowing. In the Bucky Company example, we previously calculated the weighted average accumulated expenditures to be $500,000. If the interest rate on the loan is 10%, we multiply the weighted average accumulated expenditure of $500,000 by this 10% to get $50,000, which equals the amount of interest to capitalize. The case we have just looked at is an example of when the weighted average accumulated expenditures are less than the amount borrowed for specific construction of the building. There are times, however, when the weighted average accumulated expenditures amount is greater than the specific borrowings for a construction contract. When this happens, for the portion of the weighted average accumulated expenditures that is greater than any debt incurred specifically borrowed for construction, use a weighted average of interest rates incurred on all other outstanding debt during the period. Continuing with our Bucky Company example, the weighted average accumulated expenditures amount is $500,000. Let's assume Bucky Company borrowed only $400,000 specifically for the stadium project at a 10% interest rate. The remaining $100,000 was financed through general borrowings. If we assume the general borrowings had an average interest rate of 8.25%, we then compute the interest to be incurred as follows. For the $400,000, we multiply this amount by the 10% interest rate on the specific borrowings to equal $40,000. For the remaining $100,000, we use the 8.25 average interest rate to equal $8,250. The sum of these two amounts equals $48,250. This amount is also called the avoidable interest. In the previous section, you were given the weighted average interest rate for borrowings not specific to construction of the asset. However, you must often calculate this amount on your own. This computation is straightforward and can be illustrated through the following example. For all the debt outstanding during the period, multiply the interest rate related to the debt by the principal to give you the interest related to the debt. Divide the total interest by the total principal to give you the weighted average interest rate. Our final step for interest capitalization is to compare the avoidable interest to the actual interest cost for the year. The lower of the two is the amount to capitalize. We computed Bucky Company's avoidable interest to be $48,250. The calculation for actual interest is straightforward. You multiply all the debt outstanding by the interest rate on the respective debt. For example, Bucky Company has the following debt outstanding. We multiply this debt by the related interest rate, and the sum of these amounts equals the actual interest for the year. Because the actual interest is greater than the $48,250 avoidable interest, we capitalize only $48,250 and expense the difference. Let's look at Wolverine Company. Wolverine began construction on January 1, 2001. The following expenditures were made prior to the project's implementation, December 31, 2001. Wolverine borrowed $200,000 at 12% interest from State Bank on January 1, 2001 for the specific purpose of building this equipment. Other general debt existing on January 1, 2001 was as follows. Answer the related multiple choice questions. Capitalize is to determine if the item is a qualifying asset. A qualifying asset is one that is intended for sale or lease and constructed as a discrete project over time, or an asset intended for the company's use, constructed as a discrete project over time. If the asset meets these criteria, you must then determine the capitalization period. The capitalization period begins when expenditures for the asset are made, when construction is in progress, and interest cost is being incurred. If the above criteria for a qualifying asset or for the capitalization period are not met, the interest should be expensed. If the criteria are met, you should capitalize the lesser of the avoidable or actual interest. In calculating the avoidable interest, you need to consider the weighted average accumulated expenditures, the specific debt related to the construction, the interest on the specific debt, and the weighted average interest rate. When computing the actual interest, calculate the interest incurred on the outstanding debt during the acquisition period. Capitalization should continue until the asset is substantially complete and ready for use, and you should charge the capitalized interest to the cost of the asset.